Okay, so the disclaimer and the topic today, knowing which markets to swing trade and when to go long or short. I'm going to be looking at one of our oldest strategies that we've had around for like forever because it works. It works, probably one of our original strategies. Um, it's still in play. I don't put it in the original you won't see it in the current trading plan, but people are still trading it. And if you want a copy, let me know and I'll get you a copy of the trading plan. It still works, still great. One of the original ones. These are all the sectors we trade only because these particular sectors have enough option volume and open interest to make them tradable with options. So you get a very diversified trading portfolio because a lot of people want to trade certain things and they want to specialize in certain things. And if they want to do that, great. If they just want to get a little bit of everything. So there's something here for everyone. Also, different ETFs. A contract might be priced anywhere from, it might cost you anywhere from $70, $70 up to $2,000 for one contract. So there's something in here for everyone's account size. So if you want to trade, there's something here for you that you can afford to trade and you just follow the plan and it works out. It will work out if you follow the plan and be consistent and be adequately funded and a few other things. So that's what we go over during coachings and stuff. All right. So today we're going to go over the Ichimoku Kumo buy and sell. This is what a sample trading plan would look like. Every little detail is not in here, but when I'm doing a coaching session and what I send out to coaching clients will be the trading plan. Um, in the full trading plan before the setup will be all the settings for all the instruments, for all the indicators. So I will provide you everything set up on the charts for Thinkorswim or NinjaTrader. But if you're doing a different platform, you need to manually set things up. The settings will show you exactly what values to put in for each of the indicators so you can recreate things on your own if you need to do that. Otherwise, I just provide it for Thinkorswim and NinjaTrader. All right. So you'll always see a setup trigger and trade management. That is terminology borrowed from Jake Bernstein. The setup is going to be visually what you're looking for. A trigger is a confirmation on a chart, and a trade management. Um, this is very summarized, but we go over that in detail during coaching sessions. We always buy an in-the-money call option for a long trade, or an in-the-money put option for a short trade, and it's always at least one strike in the money. And then from that point on, it's managed per plan, and we go over different things you can do to manage the position to maximize profit, so on and so forth. And so today we're going to take a look at this strategy on the chart, how to identify it quickly using the Ichimoku indicator, which is available on pretty much every analysis platform available. It's free indicator and that you can use, and it's very efficient if you know how to use it. Remember, indicators are just tools. If you don't, just because you buy a tool doesn't mean you know how to use it. Um, I know Becky and we have met people who we've gone to work with them and we have seen they purchased $30,000 worth of software tools and trading tools and every kind of tool. And they thought that just getting the tool would make them know how to trade. And no, it doesn't. No, it's just a tool. It's like going to Home Depot, buying a bunch of saws and hammers and think you now know how to build a house. No, it doesn't work like that. You need the training, you need the education, you need how to use those tools efficiently to achieve what you want as a final goal. And that's what the Ichimoku Cloud is just a tool, and how we use it is an application. It's not a textbook. Um, there are textbook type of definitions, but we don't do textbook definitions. We find ways to apply a tool to use it to achieve our goals. And that's what we're going to go over. One of those ways using the Ichimoku Kumo. Okay, the strategy. All right, so I'm going to switch off to the chart now. And if you have any questions along the way, just go ahead and don't raise your hand, but just unmute, ask it, or type it in the chat window. All right, so I'm going to switch to the, all right. So this is a chart some of you have already seen before, are familiar with. It's the Ichimoku cloud. And it was developed in Japan. It's been around for probably 60 to 70 years now. And the word cloud comes from the space in between these moving averages, which create this visual, cloud-like visual, hence the name cloud. Okay. So what we're doing is an application of using the cloud to give us directional bias, a very strong directional bias. Okay. I'm going to go over this a little bit for one of this strategy, and then I'll go back to the handout. Okay, and let's take an example from earlier this year. All right, so this is the cloud. This is basically two moving averages that create the cloud. When they cross over, they create a bullish cloud and a bearish cloud. This top line in the bullish cloud is Chiku span A. This is span A, and the bottom line is span B. When span A crosses below B, it creates a bearish cloud. When span A crosses above B, it creates a bullish cloud. There's the visual again. When span A crosses below B, span B, it creates a bearish cloud. And when span A crosses back above span B, it creates the bullish cloud, and it just keeps crossing up and down. All right. So for this particular strategy, and I'll use this is a nice clear example. Here we have a Kumo buy. And what we're looking for here, I'm going to check this date here, close 543.75 and span A. Okay, so you see where the price, each of these candles was in or below span A, the upper line of the cloud. So what we're looking for is a close above the cloud. So all these candles close in or below the cloud. They're all below span A. Let's close below span A, close below span A, close below span A. They all close inside or below this upper line of the cloud. What we're looking for is the first close above the cloud, which would be right here. And that orange line you see, this is the Chiku, this part of the Ichimoku cloud. Okay? It's one of the lines from the Ichimoku cloud. So visually, all we're looking for is a close above the cloud with the previous 4 days closing in or below the upper line of the cloud. So this closed more than 4, that's okay, but at least 4. Why we have the number 4? Because it closes up above, below. It's more of a choppy market. We don't want a choppy market. We want a solid close above. Not going up, down, up, down. We don't want to deal with that type of market. Okay? So it closes above. Previous 4 days closes in or below this upper line. And the Chiku from 26 days ago is above the cloud. So if this is the day we had our trade signal, our setup day, so you're looking for the setup to close above. If we count back, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22, 23, 24, 25, 26. This is 26 days ago. The Chiku is above the cloud. That's the confirmation. It's that simple. Okay. Um, they always ask why this stuff works, and who knows? No one ever has a good answer, but this is one of the applications that we developed using the cloud. You won't find this in any textbook. You won't find this in any definitions of Kijin or Kumo or Ichimoku any place. This is a strategy myself and Becky developed using the Kumo. We have several of them, but this is a one that works extremely well, extremely well. Um, so close above the Kumo, previous 4 days close in or below the upper line of the cloud, and 26 days ago, the the Chiku, which is one of the lines of the Ichimoku cloud, is above the cloud. If it's really close, then you have to look at the numbers in the data box to verify. Okay. And the ATR this day is 9.07. So you add on 9.07 to the open price the next day, and that's your first profit objective. So if the open price the next day is 551.42, you add 9 onto that, and your target's going to be hit somewhere in here. Actually, probably might go against you first and then hit over here. So that's how we do it. We just set up the trade the next day, buy a first in the money option at or below the open price the next day. And once we're in the position, you just set an exit order to close the position when the first target is reached, which is 9.07 points above the open price this day. Is it that simple? Yes, it is. There are a few more details on option pricing because you can't just go buy options and think that they won't expire worthless or time decay won't kill you. So the option price has to be appropriate compared to how big a move you expect. So the size of the move is a big factor of buying the option. If the option is too expensive, um, because you're expecting a really small move relative to the option price, it won't work. So that's the stuff we go over during coaching sessions. It's how to judge the option pricing because it does make a difference. On the upside, as markets go up, volatility drops out, and time decay can hurt you. On the downside, for sell trades, time decay doesn't hurt you as much because when we get a short trade, as markets start dropping, the volatility actually increases the option pricing. So although you might get seeing time decay from the option, the volatility is actually juicing up the price of the option. So that's one of the big advantages we have on short trades. We don't really deal with the time decay as much because the volatility helps us. One of the best examples was February, March timeframe of 2020, after when things were shutting down because of COVID. We had some short trades in place that were within maybe 2 or 3 weeks of expiring worthless options you might have spent $6 to $12 on. Were now worth like 50 cents type of thing. We were like, these weren't looking good. And all of a sudden, those stats and probabilities kick in. And as the market started dropping, options we thought were going to be losses, all of a sudden were hitting at 50% to 80% return at the very first target. So options that had lost 90 to 95% of their value from time decay had suddenly, because of the downside move and the massive volatility from those gaps, it just put so much premium back into those options. They ended up being way more profitable than we could have ever envisioned. We had similar scenarios over the last couple of weeks with some trades that were going against us. All of a sudden, boom, markets dropped this past week, and we had some very nice returns on some short trades. All right. Now, we were talking about when to go long and when to go short. So the short side of this is actually the same type of thing. Let's see. I'm going to look at my spreadsheet, which you can't see right now, but I'm going to look at a trade, and then I'll come back to um, that chart. I'm going to find a date. I'm going to pull up, okay, SPY. I'm going to find a short trade on SPY. And okay, so short. There aren't too many short trades just to last. We've been in a big bullish deal going on recently. Let's find a trade. See, we don't get too many fake outs either, but it's the same concept on the short side. But I want to show you an example of a trade that's not great. We don't get too many of them, but 824, getting there. So let's see. This would be an example of a trade that's not great. Closed below, previous 4 days closed above, and the Chiku from 26 days ago was somewhere below the cloud, somewhere out here. And obviously it didn't go down, it went back up. And then we have other trades to go long, multiple trades to catch this move up. But what I wanted to get across, it's here's what happened with a lot of people. They make a lot of money, then lose a lot of money. And a big reason I won't name a name, but there's someone that contacted me a while ago, and I worked with them for a while. And they literally made $1 million trading. They went from tens of thousands of dollars in an account to $1 million in the account trading. Sounds good, right? Okay. Then they contacted me after they lost $1 million. They lost $1 million because they tried to trade the exact same strategies on the long side, on the short side. So as markets started to decline, they they used the exact same strategy, just flipped it over, thinking that everything they did on the long side, they would just do the same exact thing on the short side, and they would make a whole bunch of money just like they made the money on the long side. And that is definitely not the case. That is not realistic. Um, Markets move up a certain way, they move down a certain way. Institutions acquire positions over time, getting the best possible price. It might take weeks to months to acquire a position. It takes days to get rid of a position. So you're going to get these fake outs. You get these sudden fake outs. You get a sell off, but then it just right back in. So you can't, it's going short is very much different than going long. I'm going to go back to the handout and show you the stats. I want to use that as an example. Like that's what I wanted to get across today, the difference in going long and short, and don't just flip things over and think you're going to have the same results. This is the Kumo setup on the Qs. This is every trade, valid trade on the long side and short side since 2000. 92% wins overall, but however, it's 100% wins on the long side. That's why we've had no losses. But look at the short side, 76% wins. If you're trading, so this 92 sounds really, really good. It sounds really good. I'm going to trade this. It's 92% wins overall. And then you go trade it, trade it, trade it, and all of a sudden you're like, I'm not making any money, but it's supposed to be 92% wins. But what's happening is a lot of the money you're making here on the long side, you're giving back on the short side. Okay. If you're already trading our strategies, you know we don't deal with anything under 84% wins. The way the numbers work out, we really want 85 to 88% wins to guarantee overall net profitability on our option trades because we don't know what the return option trade will be. So as long as we maintain that high percentage return, we know usually most winning trades are between 15 and 20 something percent return. If you get in a little bit better price, it can be anywhere from 25 to 60%, 70% return. But we base everything based on worst case scenario. So if I'm trading this strategy on the Qs, and I get a short trade valid, it's the exact same setup, just flipped over. I'm not taking it. Having these numbers available to you, have this is what Becky does. She does all this analysis, tracks all these trades, develops all the stats, and makes this available to coaching clients. So by knowing this, we know what to trade and what to not trade. It's so important to know what to not trade. Okay. Usually when I see people do these type of presentations, this is the number they'll show you, but not broken down long and short. So people will try to trade this up, trade it down. They'll have some nice wins. They'll give money back. They'll have a nice wins, give money back, and then when it's all said and done, they didn't make any money, or they might have a slight profit or a slight loss. And that's because this is part is what you need to know. We don't want to trade this on the short side with this strategy. There are other strategies on the short side we will use that have the 84 to 90 something percent win rate, but not this one. Okay, and this is what you need to know. That's what separates us from pretty much everyone else out there doing different coaching strategies, is having these numbers, and this has really worked for us so well, so well. Um, Another example, S&P, 83% wins. Borderline, we do 84% wins or higher, that's overall. But on the long side is 86, on the short side is 74. Once again, when this strategy becomes valid on the chart, long or short, we see it's a valid short, we're going to pass because the win-loss percentage is too low. We will take a bunch more losses, and for every one loss you take, you got multiple trades you needed to offset it because, like I said, with options, you need at least, depending on your entry, at least 3 to 5 wins to offset the loss, at least, minimally, probably more than that. Probably at least 4 to 6 wins. So we don't want to dig holes for ourselves and miss trades, and you're not going to meet every single trade. So we don't want to create situations or even think about situations where we are at a negative or at a disadvantage. So anytime we see a short trade with this strategy, we pass. Okay. We would focus on the long trades because 86% is fine. That's perfect. So, and how we know, so how do we know when to go short? Different ETFs will have different win-loss percentages. I'm just going to show you a couple of the stats from some of the strategies we have, and then it'll give you an idea of when to go short. It'll, let's see, I'm going to change back to the, let's see, oh yeah, the stats sheet. Let's scroll down, change the share. There it is. Okay, so once again, these are the symbols we trade in the sectors. And this is how we have the stats identified in the trading plan. We will have the strategy, the symbols it's applicable to. We usually have stats for all 28 ETFs, whether it's short or long. And if you see it in light blue, it means it's 84% wins or higher. Okay. So these short trades, the squeeze play sector sell, 92% wins on DIA with a 1 ATR target. The bigger you want, the bigger target you expect, the less likely it will get there. That's something another people also don't realize. You can't just arbitrarily make up a target and think it's going to work. You need something statistically to tell you that you can't just say, well, I expect this move to reach here. Like, based on what? Um, so you can't just make stuff up. The market doesn't care about you making stuff up. It has to have some statistical, realistic expectation of getting there before the option expires. So I see a lot of people try to do traditional technical analysis and forget about that options have a time element. It's not just traditional. Their analysis might be totally correct, They might do some Ichimoku thing. They might do a Fibonacci thing. They might do a Gann thing. They might do whatever thing they do. They draw lines this way, and the analysis is totally correct. Except with options, it has to happen within a certain amount of time. And for most analysis techniques, it doesn't include time. So this is a big factor for what we do. Anything we do has to factor in time. It has to reach that profit objective within a certain amount of time. It's usually 1 to 2 months of time, usually in most of our strategies. So that took a lot of time and work to develop. So the bigger a move you want, one ATR, 1.2 ATR, 1.5 ATR, it might not seem like a lot when you look at a number of points, but it does make a difference because to get to this move, it might take a straight shot right up, but to get to this move, it might move up, pull back, move up, pull back, and then move up again. It might take that much longer to get to 1.5 ATRs, or not get there at all till after the option expires. Your analysis can be totally correct, but since you wanted a bigger move, it went beyond the expiration date of the option to get there. So your option expires worthless, then it hits the target. And I think a lot of people have had that experience and don't like it. It's just took a loss. It needed 2 more weeks of time. So, and that's the deal with knowing your targets and knowing your probabilities. So I'd rather take 92% wins with a 1 ATR target and maybe try to get a better entry price. If I get a better entry price, it also creates a bigger target and gives me a way better returns. All right. So got more stats for the buy side and an example for some of the strategies we do. Um, this is 1 month, basically 2 months of time. You see the difference in win-loss percentages and the different sectors. So this is all things we provide that go with each of the strategies. Don't try to figure what this one is because it's not identified as generic. It's a generic name, but it's in the trading plan. But if we get, for instance, GLD valid on a buy setup, we look at it 77%, so we're not taking it. For this strategy, for gold, we're not going to take this strategy. We're not going to take this trade. However, if we get one on IWM, the Russell 2000, we have stats for 88%, 90% for 2 expiration cycles. The difference is you use extra premium, you pay for more time. Less time, the option is cheaper, but you have a higher probability of it expiring worthless before the target's reached. That's called a business decision you have to make. Okay. Do you want a higher probability of success, but a little lower percentage return since your upfront costs are more? Or do you want a um, higher percentage return on your win because you're paying a little bit less upfront for the option, but you have a higher risk of having a loss? Those are business, but we provide these numbers, and those are business decisions you make. That's a long side. Same strategy on the short side. So this is how we know when to go long or short, is when this particular strategy is valid on the charts. And that's what we go over with you when it go over is valid on the charts. And if the stats are 84% wins or higher, okay, then we have a potential trade. So that's a big key in knowing when to go long and when to go short. Identifying the technical part on the chart, that's easy. Most of our trades involve looking for 2 lines crossing, like I showed you on, or close above, close below something, or color change. So identifying the trade is easy. Having this information is what separates us from everyone else because we know our numbers, and by knowing our numbers, we keep our win rate very high and just keep booking positive cash flow after positive cash flow. Hook buy. Once again, you can see the difference between having more time or less time. And this is one of the strategies for buying market bottoms. This is a market bottoms buying strategy. All right, one of the oldest ones also is an Ichimoku one. So when we see it become valid, we just look to the stats and take the trade because it's usually our first buy signal. When markets have been declining, we look for this signal, and it's a very great way to pick market bottoms with a very high probability of success. All right, I'm gonna go back to the charts for a minute. I was thinking it's gonna be probably a shorter meetup today. We might have one more this year and then pick back up the first weekend in January. The last two meetups were the important ones, and if you haven't watched them, go back and watch them because there's a lot of stuff there. Um, Same thing, Raj, if you're on here, watch the last meetup we did. This is the one I went over the SPY, DIA, and QQQ thing we talked about earlier.
Okay,
And that's one you might want to check out.
sure.
Okay. Okay, and let's check, say something here. And what am I sure? Okay. Just want to put one more. Our current trade status is what I want to show you. Up until this past Friday, I had Becky update our trades up until Friday. So I always have people so hesitant in taking short trades. They'll take all the long trades and they'll pass on all the short trades. And uh, in their mind, they didn't miss many trades, or they didn't want, or they're always sketchy about taking a short trade. But look at all these short trades that have become valid over the last month that all hit targets in the last week or two. You might have had some of these trades go against you a little bit, but and then I've had people say, well, the trade's going, look at this time decay, look at this time decay. But you have to blend it out of your head, especially on the short side. Yes, it might go against you a little bit. And if you have a sell signal in an uptrending market, yes, it might go against you for a little bit. However, it's still going to be 88 to 90 something percent of those trades will reach the first target. And what happens, although you thinking, oh my goodness, I paid $7 for this put option, and now it's only worth $2.50. It's lost 60 something, 70% of the value. What am I going to do? It's Don't worry about it because as soon as the markets start to drop, volatility puts that premium back into number one, the option starts going back into the money. So right away, the pricing goes right back up, and then volatility adds to the option pricing, and that volatility being added to the option pricing is usually significantly more than the time decay lost from it taking a while it went against you. All of a sudden, you go from having your option price down to going back in the money. You're now in the money, deep in the money, and you have a nice profit of the 30, 40, 50% return to first target because you just followed the plan. So people, even as of today, I was talking to people and they didn't take some of these trades. A lot of them didn't take like all of them, let's say, because they expect the market to just go long. And this time of year, all the long trades, most of them hit targets. Done a presentation every year this time of year, and from September through early November, the market's long, and yes, all those upside targets were in fact hit. But as the markets were going up and upside targets were getting hit, we kept getting sell signals, sell signals, sell signals, sell signals, and then boom, they all hit. So this past week was extremely, extremely, extremely profitable on the short side because a lot of these trades that were like in the queue all suddenly hit. So Mark, we have long trades and we have short trades. Everything was hitting. That's why you don't second guess the stats. That 90 something percent wins. So like I told you, Raj, they're like the main indices, those come up when they come up valid. The pricing is higher, but if you can afford them, it's well worth it. It's well worth it to get into the Q and SPY, Q and SPY. The other ones are great too, but overall stats, those give you the best, and plus DIA. And basically anything you traded in the last 2 months, you've been booking profits. Okay. So that's the thing. People overthink this. They're like, well, how do I know which one to pick? Just pick one, make a decision. Get in 7 to 10 trades a month in an ideal world. If you're just trading a few symbols, is different. You don't have to get in 7 to 10 a month. But if you're trying to trade everything and you can accommodate it option price wise and account size wise, if you can get in 7 to 10 trades a month, you'll be right on and it doesn't really matter even what you trade. Just statistically, you're going to make money. And okay, so for the year so far, we are having overall 88% wins. Once again, overall means nothing. You got to break it down long and short. Long trades, 89% wins. Short trades, 88% wins. Pretty even for the year. This was a great year to book profits. If you second guess it, you can't second guess. It's so when we do these strategies, it's not something we're experimenting with. It's something we've been doing for a long time. This is an end product. This is the end game. This is not something that's in development. This is works. You just have to place trades. So my job is to show you what to do, help you as much as I can, but your job is to place the trades. So I know some people get fearful. They want to watch. They want to place like 2 or 3 trades and just watch them. Well, I'll watch and see how these turn out. You you have just found the number one way to have a losing account because you just watch it. You have to be booking profits. What if the ones you bought has happened to be the ones that are going to be losses? You're going to sit there for 2 months and watch them be losses while not booking any other additional profits. So let's go down here. It's been a while since we had a loss. Let's say this is the one you got, and I've had people do this. They buy at SPY. Oh, they got to put, um, and they're gonna watch it. Or they got this one and another one later on. That's a long. So they got one long that ends up being a win, one long being, but they just watch this. They just watch it be a loss. They just watch it. And I said, well, your strategy is not working. I just lost money on this option. And then I always ask, okay, so this is in August. You got this in August, which means it's going to be expiring August in October. So out of the next 30 something trades that were wins, how many were you in? Answer is almost always zero because they were watching this trade as opposed to placing trades and booking profits, booking profits, booking profits. If they place this trade, it ends up being a loss while they were watching it, but not bringing in any of the. If several of these trades will book enough profits to offset the loss and add profit, so they could have had this option won't expire until October because October. So during all these months, you should be booking profits. So if this one becomes a loss, big deal because you have so many wins during that time, it more than offset the loss and then some. And I always look at dollars made to dollars lost. You always hear about risk one to make three. We don't risk one to make three. We make 3 to 5 for every one lost. Actually, more like $3 to $6 for every one lost. That's more the goal. We make 3 to 6 for every one lost, not risk one to make three. We make $3 to $6 for every $1 lost. That's what this period looks like if you're consistent with your trades. You will not be in every single trade. It will not happen that you're in every single trade. Sometimes the option pricing isn't quite right, open interest kind of low, but there are enough trades here that there's no reason you can't get into 6, 7, 8 trades a month. Ideally speaking, 7 to 10 trades a month because all these options are different expirations, different pricing. So or there might not be a good opportunity today, but if the market pulls back a couple of points, then you get in, and then the numbers make sense. So much opportunity here to book profit. So you can't just sit there and watch it because that won't that doesn't work. You have to place trades. You want to be a trader, you got to trade, and it's been a great several months of trading. So there's booking profits, booking profits, booking profits. It's the kind of year where we do in fact expect to see that $5 to $6 made for every $1 lost, as long as you're very consistent with your trading. If you're not consistent with your trading, that's a whole different story. I've had people also they take a 10% loss on an option. Well, it went all the way to it took so long to hit a target, we lost 10%. So it was a negative 10% loss. Okay. And on the other trade, you made a 25% return, right? Yeah. And you risk about the same amount of money in each trade, yeah. So you're telling me that you made $2.50 for the every $1 you lost? What? It's just numbers. If on one trade you lost $100, and the other trade you made 250, then you made $2.50 for every $1 you lost. And I have people think about it like that. It's money, it's just numbers. Yeah, so because everyone focuses on, well, I lost 10% of this trade. Big deal. You made 25% of the other trade. Do the numbers. As long as you keep your risk around the same on every trade, that's the way the numbers work out. It's very in your favor. You don't even think about time decay. The 10% would be basically a time decay thing. Great, you might lose 10% on one trade, but make 25% on the other one. It's just numbers, and it's just fine. But everyone will focus on that 10%. And big picture, open up, look at the big picture. You're doing extremely, extremely well. And then you have all other trades booking profits. All right. So this is what I want to get across for today is just knowing when to go long and when to go short. Follow the plan. Um, I use the Kumo strategy as an example, but we actually trade 6 strategies on 28 different ETFs and then 2 additional strategies just for the Dow, Nasdaq, and S&P. But this is what it looks like for this year. We actually have all the stats that go back. I think 2020 was the COVID year, one of those great years of trading when everyone was stressing and with COVID. Um, we just had really, really good trades going on. It was such a profitable year with, with between wins and losses. But this is what stuff I wanted to have Becky document so people can see, go through and scroll back and see the big picture of all the trades that happened and were you in them? Because people always think, well, we didn't miss very many trades, it's not a big deal. But when I point this out, you missed a lot of trades. Here's the win-loss percentage. People don't realize how many trades they miss when they pass because they see it's volatility. No, we want volatility. So this was the 2020. Put the win-loss stats up on the corner side there. This was 2020, 89%, 92. This was the win-loss stats in 2020 when people in the market were taking huge moves. Fear sets in and people get paralyzed in trading. But when you know your numbers like this, you take the trades. 2021, you know your numbers, very consistent. 2022, I think we were a little bit lower on some of the trades. It was at 80%, 85%. Wow, really, really low. Really, really low. 80, 85%. Still very profitable as long as you're consistent with your trading. Even trading down Nasdaq and S&P, that's different. That's a much higher win-loss percentage. 2023, right around 80%, right? Once again, if you're trading down Nasdaq and S&P, best results. 24, 86 overall, long side, short side. As long as you're consistent with your trading, you're good. And here we are in 25 up until now. So there's no real losing years doing these strategies. It's a matter of consistency and know that as long as you're very consistent and if you can find some scenarios of getting at a better price than expected, then take a look back at the last couple of meetup videos we did, then you'll see those examples also. But those are opportunities to turn a 15 to 20 something percent return into a 50, 60, 70 something percent return on just the first profit objective, right? So for today, we said we might have one more meetup for the year. Is there any questions anyone has on anything, whether it's these strategies or something else? Anything at all? I was planning on a shorter presentation today. Maybe do one more before the year's over. The important one was the last one we did. That was setting up. Actually, here's a good example of good profitability. Kumo buy. This one was 829.23. Let's see, 5 open, 449.51 and a high 453. I'm going to uh, okay, so okay, here. So here's one where you have a buy, Kumo buy, and the ATR target is $5.49, and you have at least a week to get into it. Now, if you get into it right at the next day's open at 408.85, and the first target is going to hit maybe 2 weeks later, and you're going to have about a 20 to 25% return. It's going to be a nice trade. But if you open price is 408.85, let's say you get in a couple days later, this open is 406. Just by getting in 2 point something points lower, your 25% return up here is going to suddenly be about a 40 something percent return because you get 2 more points of profit in the money. Okay. Suddenly, by getting here, you're getting in your ATR is 549. So your target is $5.49. You get in 2 points lower, your target goes from 549 to 749. So that bigger target gives you a lot more profitability at the first target. Just by, you don't have to rush to get into trades. Just by being relaxed, you can get in a couple days later at a better price. So 10 different people taking this trade will get in at 10 different prices, 10 different times over the next 1, 2, 3, 4, 5, over the next 6 days. They'll all get different results because they got different days, different prices, but all valid entries along the at or below the open. Um, some people might get in right at the open. Some people might get in a couple days later down here, 2, 3 points lower, and they'll get a much better return than the person who got in right away. This person getting in right away is going to get. I want to switch over to the chart. I think I was showing you the, or was it actually showing you the chart? Was I? Let me switch, go through that again real quick. Okay, so here is an one of the Kumo buys, and the open the next day is 408.85. But if you get in a couple of days later, you get in 2, 3 points lower, and that can make a difference of having a 20 something percent return to having a 40 to 50% return under when the first target's reached, just by simply getting in at a better price. Same trade, like I said, 10 different people taking this trade will get in different days, different prices, different times, and get 10 different results. All wins, but how much of a win will be different, will differ. So for today, do we have any questions? Otherwise, I'm going to end the presentation for today and have one more probably in about 2 or 3 weeks, right after Thanksgiving, most likely. And it might be futures, it might be options, depending on what people want to do. And then we'll pick it up from there. And that'll be the last one for the year. And then we'll start back in January, right after New Year's, because that's always a big one as things are getting going. All right. If we don't have any questions, we'll end it now, and then I'll send this video out later on and see you all in a couple of weeks.
Sure. Thank you.
Thanks.